If you've spent the last 20 or 30 years following solid retirement advice, saving in your 401k, maxing out your IRA, building a nest egg, I want you to hear this clearly. The moment you turn 70, almost everything about that advice changes. The rules that helped build your retirement are not the rules that protect it. And if nobody has sat down with you and explained exactly what shifts at this stage, you could be making decisions right now that cost you thousands of dollars in unnecessary taxes, Medicare surcharges, or missed opportunities. And you wouldn't even know it until the bill shows up. So today, I want to walk you through the 5 biggest shifts that happen after age 70 and what you can do about each one. Let's start with the one most people have heard of but don't fully understand. Required minimum distributions, or RMDs. Under current law, you're required to start taking withdrawals from your traditional IRA and 401k accounts at age 73. The IRS has waited patiently for decades while your money grew tax deferred, and now it's time to collect. Here's the part that catches people off guard. The IRS doesn't ask you if you need the money. It doesn't ask you if you have other income already covering your bills. It simply calculates a required amount based on your account balance and your age, and you have to take it, whether you want to or not. Let me give you a simple example. Let's say a retiree, we'll call him David, has built up $800,000 in his traditional IRA by the time he turns 73. His required withdrawal that first year is roughly $30,000. That $30,000 gets added to whatever other income he has, pension, Social Security, part-time work, and it could push him into a higher tax bracket than he expected. Here's the key insight. The decisions you make at 70, even before RMDs officially start, directly affect how large that first required withdrawal will be. The bigger the account, the bigger the RMD, the bigger the tax bill. Which is why planning ahead of 73, not just reacting once it starts, makes such a difference. Now let's talk about Social Security. By the time most people reach 70, they've already made their claiming decision. In fact, if you waited until 70 to claim, you're now receiving the maximum benefit available to you. So at this stage, the question isn't when should I claim anymore. The question becomes, how do I keep more of what I'm already receiving? This is where something called provisional income comes into play. Provisional income is a formula the IRS uses to determine how much of your Social Security benefit is actually taxable. It combines your adjusted gross income, any tax-exempt interest, and half of your Social Security benefit. Depending on where that number lands, up to 85% of your Social Security benefit could be taxable. For many retirees, this comes as an unpleasant surprise. They assume Social Security was simply their money coming back to them tax-free. It often isn't. And this is exactly where your next decision, how you handle Medicare and IRMAA, start to connect directly back to Social Security. Here's something that surprises almost everyone I talk to. Medicare premiums are not flat. They're based on your income. It's called IRMAA, the Income Related Monthly Adjustment Amount. And here's the part that trips people up. IRMAA looks back 2 years at your modified adjusted gross income, or modified AGI, to determine what you'll pay for Medicare Part B and Part D today. That means a decision you make this year, like a large Roth conversion, selling an investment property, or a bigger than usual withdrawal, could quietly raise your Medicare premiums 2 years from now. Let me share an example. Carol, a retiree we worked with, sold some highly appreciated stock to help her daughter with a down payment. It felt like a one-time harmless decision. 2 years later, she received a letter informing her that her Medicare premiums were going up by several $100s a month for an entire year because that sale had pushed her income over an IRMAA threshold. This is why I encourage clients to think of modified AGI management as an annual checkpoint, not a one-time decision. Every withdrawal, every conversion, every sale needs to be looked at through the lens of, what will this do to my Medicare premiums 2 years from now? Now, let's talk about your investment mindset, because this is where the biggest psychological shift happens. In your accumulation years, time was on your side. If the market dropped 20%, you had years, sometimes decades, to recover. After 70, that math changes. This is where something called sequence of returns risk becomes critical. If a market downturn happens early in retirement while you're also pulling money out for income, the combination can do lasting damage to your portfolio. Damage that's much harder to recover from at this stage of life. This is why so many retirees shift their thinking from how much growth can I get to how much can I count on no matter what the market does. One strategy I talk with clients about is building an income floor. The idea is simple. Cover your essential expenses, housing, food, healthcare, with guaranteed income sources. That might be Social Security, a pension if you have one, and in many cases a fixed indexed annuity with a guaranteed lifetime income rider. A fixed indexed annuity isn't right for every dollar or every person, and I always say that plainly. But for the portion of your portfolio where you simply cannot afford a loss, having an option that protects your principal while still providing growth potential and guaranteed income for life is worth understanding. The goal isn't to chase the highest return anymore. The goal is to make sure the lights stay on, the bills get paid, and you're not lying awake at night wondering what the market did today. Finally, let's talk about legacy. After 70, every financial decision starts carrying a dual purpose. How does this affect me now, and how does this affect what I leave behind? This is the stage where reviewing your beneficiary designations matters more than ever. It's also when many retirees consider Roth conversions, not just for their own tax picture, but to leave a tax-free inheritance to their children. And if charitable giving is part of your life, qualified charitable distributions, or QCDs, let you direct money from your IRA straight to a charity, satisfying your RMD without adding to your taxable income. The bottom line here is this. At 70 and beyond, your plan can't be something you set once and forget. Tax law changes, your account balances change, your family's needs change. This stage calls for an annual checkup, not a one-time plan. So let's recap the shift. Before 70, your focus was on building. After 70, your focus moves to coordinating. Your RMDs, your Social Security taxation, your Medicare premiums, your income strategy, and your legacy, all working together instead of in isolation. If you're approaching 70 or you're already there, take a look at the free booklet called Retire Smart. It's linked on the page in the description box. If this video helped you think about your own retirement timeline differently, please subscribe to the channel. I'm Shonda Prescott, and this is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.